My wife insists that Chubb is the stock to buy right now. She said we can be rich buying the stock. I don't buy hype, so I'm going to do some study and not follow blindly. But how do I start? The point here is to be rich. Maybe I need to study how much the stock can make me in 10 years' time. Let's do this by estimate how much is the company profit in 10 years' time. Since everyone in finance is telling me to use EBITDA, I am going to use EBITDA. I will extract the data from stockanalysis.com. Think about it. Where do you think this number lands? Will the EBITDA be higher or lower? So in 10 years' time, based on the last 10 years, annual growth rate of the company, 23.8%, and assume the growth is slowing down year over year. Chubb EBITDA will be $70 billion in 2034. Right now, people is buying the stock around 10 times the EBITDA. It means if a company now profit $1 a year, people will buy it with $10 in the last 10 years. People usually buy the Chubb stock with 13 times the EBITDA. As I personally think, dividend received is my profit too. I will be adding up the dividend I am getting in 10 years' time. So, to get the final price of the stock, I will be adding up 13 times the EBITDA plus the dividend. And the stock price is expected to be $1.6K right now. The stock price worth $276, meaning I will earn 4.8 times my investment. Putting in $1,000 will earn around $4.8K in 10 years' time. Sounds like a bargain. But the finance people also says best way of investment is to put in trust fund to be rich. I would need to beat those giant S&P and QQQ. Similarly, I extracted the data from stockanalysis.com using S&P 500 stock growth in the last 10 years. I am assuming 10 years later, it will be 2.2K, giving myself 2.6 times profit. And QQQ will be giving me 3.4 times profit. Now, in comparison, buying Chubb stock sounds great. Better than QQQ, but hold up. After some research, they're saying cash is king. Do you think their cash performance can be better than the QQQ? All right then, I am using the same method. Estimating the free cash flow 10 years later, the stock price will ended up to be $1.1K, meaning putting in $1,000 will be earning around $3K in 10 years' time. Sounds like a bad idea, lower than QQQ. I personally like dividend. Let's use the same method on dividend gain. The stock price will ended up to be $1K, meaning putting in $1,000 will be earning around $3K in 10 years' time. Sounds like a bad idea, lower than QQQ. Let's average all three methods, taking all consideration, and see how it goes. The stock price will ended up to be $1,256, meaning putting in $1,000 will be earning around $4.4K in 10 years' time. Sounds like a bad idea. Buying Chubb can get us $4.4K and QQQ is getting us $3.4K. Seems like buying QQQ is a better idea. Okay, the number seems terrible. But why? Let's study more about their business. Let's quickly break down the general information and the segment analysis. Starting from the general information. So, what does this company Chubb actually do? They handle risk. All kinds of insurance. Global commercial, personal stuff. Life and reinsurance. They're everywhere. Active in 55 countries. Management is sharp. Very focused. Their big push now? Digital sales. Emerging global markets like Asia and climate tech. The future plan is clear. Grow big, expand in Asia, and keep that disciplined underwriting. Okay, I don't think that's enough. I know their story now, but how did Chubb earn their money? It's actually simple. 5 major buckets. Bucket 1, the biggest one. Number 1 is commercial insurance. That's the main gig. The biggest share, it's for businesses. All sizes. If a factory burns down, if a customer slips, if a worker gets hurt, they cover it. It's the daily risk of running a company. Bucket 2, the rich clients. Right after that is personal insurance. This is for the really wealthy folks. Think giant homes, fancy cars. Rare art collections. It's specialized, high-end coverage. They also sell general travel and health policies globally here. Bucket 3, the smart money. Investment income. This is pure profit. It's money earned from a clever trick. They collect your premium today. They don't pay your claim until tomorrow. In between, they take your money and invest it. That earned return is this bucket. Billions of dollars. Bucket 4, overseas growth. Then, life insurance. A huge source of income now, mostly selling policies in Asia. Savings plans. Protection plans. This is a major growth engine for them right now. Bucket 5, insurance for insurers. And finally, reinsurance. This is the most specialized bucket. It's insurance for other insurance companies. They cover the truly massive risks. Major earthquakes, huge hurricanes, catastrophes. So, their money comes from everywhere, covering your local bakery, protecting a billionaire's yacht, trading bonds, and insuring other global insurers. It's all about managing risk and turning that risk into serious profit. So, now we know the potential return and what the business is about. Is that enough to make an informed decision? That is not quite right. You see, buying a stock without checking the financials is like marrying a partner based only on their looks. It's gambling, plain and simple. If you've watched this far, you're serious about investing. And we need to run the numbers. To do that quickly, I developed a 22 checklist that pulls insights from the balance sheet, cash flow, and income statement. Running these 22 checks manually is tedious. So I use the fast download feature at stockanalysis.com to pull everything to Excel for calculation. This is the fastest way to get your insights. You can access the data and my recommended tools through the link below. Use the discount code STOCKSNACK. Starting off with the balance sheet, we are checking 7 metrics. Out of the 7, we got 4 metrics with a good score. So, let's talk about Chubb's real financial health. We looked deep into the numbers, and the picture is very clear. Liquidity and debt, you see, for a normal company, cash versus debt is a huge deal. For Chubb, it's great. They can generate cash, lots of it. They hold much more cash than immediate debt. The ratio is strong. It tells a good story. Funding strategy now. Look at how they fund the business. They rely on themselves, not debt. Their decade-long average for debt to equity is very low, just 31%. This means they are heavily self-financed. They own most of their operation. And a cool detail, 0 preferred stock. They don't need emergency funding. They don't need special investors. Growth and efficiency, the growth numbers are also strong. Look at retained earnings. They grew at a 14% average. This shows amazing ability. They can compound earnings, even through bad economies. That is a massive strength. The surprising gaps, but here are the wrinkles. 2 big insights stand out. First, performance efficiency is weak. The return on equity row is only 11%. It should be 25% for top companies. Their return on total assets ROTA is also low, just 3%. This means they are financially very safe. But they are not maximizing the profit from their existing assets and equity. They are being too conservative with that massive float. Second, the share buybacks. The treasury stock metric shows the cumulative buybacks are 0. Wait, that's bad. It means they aren't consistently using their profits to reduce outstanding shares. This is a missed opportunity. They should be returning value directly to shareholders, but they aren't. So Chubb is safe, self-funded, and growing earnings, but they are inefficient and not optimizing returns for shareholders. That's the real story. Next is income statement. We are checking 9 metrics. Out of the 9, we got 7 metrics with a good score. Okay, let's talk about Chubb's core earnings machine. This is all about how efficient they are. You see, their gross profit is huge. The margin is consistently over 40%. It sits at 43%. This is a massive signal. It means they have incredible pricing power. Clients are willing to pay a premium. They trust the brand, and getting the product sold is cheap. Their sales and admin costs, the SG&A, are only 19% of profit. That's fantastic efficiency. The product almost sells itself, plus 0 spent on R&D. Insurance is a simple business model. No new widgets needed. That keeps costs down. Their debt is low too. Interest payments are manageable. No heavy burden there. The profitability puzzle, but here are the conflicting insights. The 2 big ones. The first is profitability. Their net income, as a percentage of revenue, is only 15%. That is actually a bad score. They make great money from pricing. But all the other cost claims, reserves, investments they eat into the final profit. It suggests they have a competitive advantage in sales. But that advantage is constantly being offset by other operational complexities. The tax quirk. The average tax rate is only 13%. It should be around 20% for a credible global company. This low rate suggests heavy use of international jurisdictions. It saves them money, sure, but it flags a potential dependency on complex tax structures. Here's the final takeaway. Chubb is a cash-generating powerhouse. They have strong pricing power and efficient operations. They are safely leveraging debt, and their EPS growth is fantastic. You see a healthy, growing stock, but the low final profit margin and the odd tax structure show to clear things. Efficiency is not maximized, and they rely on tax optimization to protect the bottom line. It's a complicated quality picture. Next is cash flow statement. We are checking 6 metrics. Out of the 6, only 3 metrics got a good score. All right, let's talk about where Chubb's cash actually goes. This is where the real operations show up: management and compensation. First, the executive incentive, stock options. They keep the stock compensation extremely low. That's a good sign. It means management is not aggressively diluting current shareholders. They aren't flooding the market with new shares just to pay themselves. It aligns management's goals with the company's long-term health. Very responsible. Now for the tricky part: cash versus earnings. You want a company's actual cash flow to be higher than its reported net income. That's quality earnings. But Chubb shows the opposite. Operating cash flow is lower than net income. The ratio is only 0.63 over the past decade. That's a bad trend. It means the profit they report on paper is not fully translating into real cash in the bank. Their earnings quality is low, and this problem is getting worse. Look at the cash flow growth versus net income growth. The cash flow growth is lagging behind, significantly. It means they are using more and more cash just to keep the lights on and manage claims. There's a hidden high cash outflow happening somewhere. Cash allocation, finally. What are they doing with the money they do generate? Capital expenditures, CapEx, are virtually nil. This makes sense. They are an insurance company, not a factory. No major plants to build, and they are conservative with shareholder returns. They only spend about 31% of their free cash flow on dividends and share buybacks. This is a good sign for stability. It means the company is retaining most of its cash for future growth. Or, more likely, building up those capital reserves to manage the risk they are underwriting. The bottom line here: Chubb is capital disciplined, but its cash flow quality is poor. The growth in earnings is not matching the growth in actual money coming through the door. The combined financial score is good, 14 metrics with good scoring out of 22 metrics. Now, it is time to make the conclusion. So, is what my wife said correct? Will I be rich buying Chubb stock? By the profit-wise, buying QQQ or S&P 500 is having more potential than Chubb. However, it is having a good financial health. It's a stock worth monitoring. Now, the analysis is complete. Once again, if you needed tools for your investment strategy, give a try to stockanalysis.com. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.